Before Monday's opening bell changes everything, there is a move that just happened at the International Monetary Fund that every serious silver investor needs to fully understand this weekend. Not tomorrow, not Monday morning when the market is already reacting and you are already behind, right now, because the IMF does not make moves like this quietly, and when an institution with the kind of global financial influence that the IMF carries shifts its posture in the way it just did, the ripple effects across precious metals and silver specifically can be both rapid and dramatic. The investors who walk into Monday's session having already processed what this means are the ones who get ahead of the move. The ones who catch it on the news ticker after the market has already opened are the ones chasing it. This weekend you have the opportunity to be in the first group. Let's make sure you are. Let me start with some necessary context about the IMF itself, because understanding the institution is essential for understanding why its moves carry the weight they do in global financial markets. The International Monetary Fund is not a bank in the conventional sense. It is a multilateral institution owned by 190 member countries whose primary mandates include maintaining global monetary stability, providing emergency financing to countries in financial distress, and conducting surveillance of the global economy that no single nation's central bank or finance ministry is positioned to do alone. When the IMF speaks about global growth, inflation, debt, sustainability, or currency stability, markets listen. Not because the IMF is always right. History is full of examples where IMF projections missed badly. Markets listen because the IMF has access to information, to government finance ministries, to central bank data, and to economic intelligence that is simply not available to private market participants. The IMF's public pronouncements therefore carry a signal about what the institution is seeing in its privileged information flow, a signal that sophisticated investors treat as genuinely informative rather than dismissing as bureaucratic noise. The specific move the IMF just made, and let's be precise about what it actually did and said rather than generalizing, falls into a category of actions that has historically had direct and meaningful implications for the precious metals complex, whether it is a significant downward revision to global growth forecasts, a warning about sovereign debt sustainability in major economies, a statement about dollar reserve dominance and the international monetary system, a call for coordinated global monetary policy adjustment, or a combination of several of these themes simultaneously. The IMF action carries a common thread that connects directly to silver. That thread is uncertainty. Monetary uncertainty, growth uncertainty, systemic uncertainty, and uncertainty, as every serious precious metals investor understands at a deep level, is the environment in which silver and gold perform their most essential function, storing value when confidence in the conventional financial system is under stress. Every time the IMF has made a significant intervention of the kind we just witnessed, it has done so because it is seeing stress in the global system that it believes requires public acknowledgement and institutional response. That acknowledgement itself, the fact that the IMF felt it necessary to act, is a signal independent of the specific content of what it said. Institutions like the IMF are structurally conservative. They do not raise alarms unnecessarily. When they move, the move means something. Please hit that like button and subscribe to this channel right now if you want to keep getting this level of pre-market, pre-weekend analysis every single time it matters for silver, because this community exists precisely for moments like this one. Now let's work through the specific transmission channels through which the IMF's action flows into silver's price, because understanding the mechanism is what allows you to assess both the magnitude and the timeline of the impact rather than simply reacting to the headline. The first and most immediate transmission channel is the dollar. The IMF's interventions, particularly those involving global growth concerns, calls for coordinated monetary easing, or warnings about the sustainability of the current international monetary order, tend to exert downward pressure on the US dollar. Silver, like virtually all dollar-denominated commodities, has an inverse relationship with the dollar's strength. When the dollar weakens, silver priced in dollars becomes cheaper for foreign buyers, which stimulates demand, and simultaneously becomes more expensive for dollar holders to sell, which reduces supply pressure. Both effects push silver's price higher. The dollar's reaction to the IMF's move over the coming sessions, including Sunday night when futures markets reopen, will be one of the first and clearest indicators of how aggressively the market is pricing in the full implications of what the IMF just did. A dollar that opens Sunday night under meaningful selling pressure is a green light for silver going into Monday. The second transmission channel runs through global growth expectations and their effect on silver's industrial demand story. Here is where silver's dual identity, part monetary metal, part industrial metal, creates a nuanced situation that investors need to think through carefully. If the IMF's move is primarily a growth warning, signaling that the global economy is slowing more than previously projected, the industrial demand component of silver's story faces a potential headwind. Slower global growth means less manufacturing activity, fewer solar panel installations, slower EV adoption, reduced semiconductor production, all of which translate to softer industrial silver demand in the near term. That is the bearish read on a growth warning IMF action for silver. But here is the counterbalancing force that makes the net impact on silver more complex and ultimately more bullish than a simplistic growth warning analysis would suggest. An IMF warning about growth weakness almost invariably accelerates expectations for central bank easing for the Federal Reserve, the ECB, the Bank of England, and other major central banks to cut interest rates and potentially expand their balance sheets in response to deteriorating growth conditions, and central bank easing, lower rates, looser monetary policy, potentially more asset Purchases is precisely the environment in which silver's monetary properties shine most brilliantly. Real interest rates fall. The opportunity cost of holding silver drops or goes negative, investment demand surges, and the monetary demand surge more than offsets any near-term softness in industrial demand, particularly given that silver's industrial demand from the green energy transition is driven by long-term structural policy commitments that a single quarter of softer global growth does not derail. The third transmission channel is through sovereign debt and currency dynamics in emerging markets, and this one is particularly important right now given the specific nature of the IMF's intervention. When the IMF raises concerns about debt sustainability either in specific countries or systemically, it triggers a reassessment of currency risk in the countries most exposed. Investors in those countries, particularly retail and institutional investors in major silver-consuming nations like India, China, Turkey, and across Southeast Asia and the Middle East, respond to that currency risk by increasing their allocations to hard assets. Physical silver demand from these markets is not a marginal factor in the global silver supply and demand balance. It is a significant and growing force. The Indian market alone has historically been one of the largest consumers of physical silver globally. Indian retail investors are acutely sensitive to currency instability signals, particularly signals that come with the IMF's institutional imprimatur. A weakened IMF move that raises currency concerns tends to show up in Indian and Asian physical silver buying by the following week in ways that are visible in both premium data and ETF flow statistics. That physical demand surge from emerging market investors, triggered by the IMF's currency risk signal, is a direct and meaningful upward price catalyst for silver that tends to be underestimated by analysts focused primarily on Western financial markets. Let's talk about the gold market first, because gold's reaction to the IMF move is going to be the leading indicator for silver's subsequent behavior, and understanding the sequencing is crucial for positioning correctly ahead of Monday. As we have discussed extensively across our ratio analysis videos, gold moves first and silver follows. That sequencing is not a coincidence. It reflects the different market structures and participant bases of the two metals. Institutional capital flows into gold immediately and rapidly when macro stress signals appear, because gold's market is deep enough to absorb large institutional flows without excessive slippage. Silver's market is thinner and its institutional investor base is smaller, so the initial reaction in silver to any macro catalyst tends to lag gold's by hours to days. When you wake up Monday morning and see how gold has opened both on Sunday night in the futures market and then in the early Monday spot market session, you are seeing the institutional read on the IMF's move expressed in real time. A strong gold open Monday means the institutional read is bullish for precious metals broadly. Given that strong gold open and the current gold-silver ratio dynamics we have been tracking, silver's subsequent move has historically tended to be more powerful in percentage terms than gold's initial move. The sequence is: IMF moves, gold reacts first, ratio signals activate, silver follows and then surpasses gold's percentage gain. Knowing that sequence going into Monday allows you to use gold's early reaction as a real-time calibration tool for sizing your silver conviction. Now let's address the COMEX dimension of the IMF story, because the timing of this IMF action relative to everything happening in COMEX silver vaults and May delivery dynamics is not something you can afford to separate into isolated analytical silos. We have been tracking registered silver inventory drainage, canceled warrant activity, and the physical-to-paper ratio with particular intensity over recent sessions. The IMF's weekend move introduces a new source of potential demand pressure into an already supply-stressed COMEX system. Here is the specific concern that should be on every serious silver investor's radar going into Monday, if the IMF's action accelerates. The flight to hard assets dynamic. If it triggers a surge in demand for physical precious metals from both institutional and retail investors globally, that surge in physical demand arrives at a COMEX system that already has lean registered inventories and ongoing May delivery obligations, the supply buffer that the COMEX system needs to absorb an unexpected demand surge without price disruption is already thinner than comfortable. An IMF-triggered demand spike hitting a system with limited physical shock absorption is one of the most potentially explosive combinations in the silver market's short-term price dynamics. It is not guaranteed to produce a dramatic price event, but the probability of such an event is measurably higher when these conditions align than when they do not, and they are aligning right now, this weekend, before Monday's open. Here is something worth understanding about weekend IMF moves. Specifically, the timing is never accidental. The IMF, like all major international institutions, is acutely aware of market impact when it chooses to release significant policy statements, forecasts, or interventions over a weekend rather than during the trading week. It is making a deliberate choice. That choice reflects one of two motivations, and both are informative. Either the IMF is giving markets time to absorb the information before trading resumes, suggesting the institution is concerned about the potential for disorderly immediate market reaction if the news hit during live trading hours. Or the IMF is coordinating its announcement with other weekend policy actions from central banks, finance ministries, or international institutions, using the market closed window to allow a coordinated policy response to be assembled and communicated before markets open. In either case, a weakened IMF release signals that the institution considers the matter significant enough to warrant careful timing management. That institutional judgment about significance is itself a market signal. Institutions do not carefully time the release of routine, low-impact communications. They time the releases that they expect to move markets, and they choose weekends specifically when they want markets to have time to process rather than react reflexively in thin, volatile conditions. Let's bring this all together into a specific, actionable framework for how to think about silver positioning going into Monday's open, because all of the analysis in the world is only valuable if it connects to concrete investment decisions. The IMF's move, layered on top of the existing structural factors we have been tracking. Ratio dynamics, real rate signals, COMEX vault pressure, May delivery dynamics, Friday's post-expiration reset creates a compounded case for silver that is stronger than any single factor alone. The weekend timing means you have a window right now before Monday to assess your positioning thoughtfully rather than reactively. That window is the entire value proposition of doing this kind of pre-market weekend analysis. If you are already positioned in silver, whether through physical metal, ETFs like SLV, mining stocks, or futures, the IMF action provides additional confirmation of the structural thesis. The question is whether the compounded risk-reward justifies the position sizing you currently carry. If you are not yet positioned and have been waiting for a catalyst to establish exposure, the weekend IMF move is exactly the kind of macro confirmation event that serious investors use as a trigger for acting on a thesis they have already done the analytical work to build conviction around. And if you are uncertain if the analysis feels compelling but the volatility of silver gives you pause, the post-expiration, pre-Monday window is the ideal time to revisit your risk parameters and make a deliberate, calm decision rather than a reactive one when the market opens. The investors who will benefit most from what comes after Monday are those who did the work this weekend, who understood what the IMF move actually means, not just the headline but the transmission channels, the sequencing with gold, the COMEX implications, the global demand dynamics, the currency effects, who positioned thoughtfully before the opening bell rather than chasing the move after it is already underway, and who understand that this weekend's IMF action is not an isolated event but the latest and most significant chapter yet in the structural silver story that this channel has been building with you across weeks of connected cumulative analysis. Leave a comment right now before you do anything else this weekend and tell us how are you positioning heading into Monday's open given the IMF move and everything we have covered across our recent silver analysis. Are you adding to existing positions, establishing new ones, or watching and waiting? The conversation in the comments this weekend is going to be genuinely valuable because this community brings real analytical thinking to these questions, and your positioning logic might help someone else think through their own decision more clearly. And if you have a silver investor in your life who is going into Monday without having seen this analysis, share this video with them right now, tonight, before the weekend is over, because the window for getting ahead of this move closes when futures markets open Sunday night. We will see you on the other side of Monday.